Over the last few months, cryptocurrency has dropped significantly. A lot of very smart people have lost money. A key reason being is that they didn't stop to ask one simple question, and that is, what am I actually buying? So I don't know where cryptocurrency is going to go in the future, next month, next year, and neither does anyone else. So I'm not going to make any predictions. But what I will offer is a simple three-question test that we can use to evaluate any investment, crypto included. Hi, I'm James Harrington. I'm a self-taught investor, and I focus on building wealth safely and protecting it. A few months ago, I read an article with an interview with Nobel laureate Paul Krugman, and he was very skeptical of cryptocurrency. In fact, his argument is quite straightforward. He says that crypto doesn't really function well as money. It doesn't generate income, and it gets most of its value by the belief that someone else in the future is going to pay a higher price. In other words, it behaves like a speculative asset as opposed to a productive one. So you don't have to agree with Krugman to learn something valuable from this criticism. So instead of asking, is crypto good or bad, I think a better question is, what makes any investment good or bad? So here's the red flags I watch out for. The three-question investment test. The first test question is, does it create real value? So a good investment, in my opinion, produces something people actually need or use. It creates value. Products, services, infrastructure, things that improve lives and help businesses operate. As an example, we can think about Disney. The company produces entertainment, creates entertainment people willingly pay for again and again. So that is an example of a good investment, a productive asset. A bad investment, on the other hand, and I'm using bad in terms of what I consider investment quality. So for long-term investors, I'm considering a bad investment is something that would be more of a speculative asset. Let's look at gold as an example. And people say, everybody wants to own gold, but do you really want to own it in your portfolio to the exclusion of buying a productive asset? So what we're doing is we're comparing a productive asset and a speculative asset, and we're going to use gold as an example. So if we go back 50 years, let's say 1976, we go back 50 years, and I take $1,000 and buy gold, and I take another $1,000 and buy the S&P 500. Where am I today, 50 years later? The S&P 500 stocks have outperformed gold by 5 times. So what is that telling us? Over decades, over the long haul of investing, that productive assets such as stocks perform better. Now, does that mean individual stocks perform better than gold? Maybe yes, maybe no. But I'm talking as an asset class. The stock market over time has performed 5 times better than gold has. So yes, if you buy an individual stock that goes belly up, yeah, absolutely. But we're not talking about individual stocks. We're talking about the asset class of gold compared to the stock market. And so that's an important point to make, is that productive assets are characterized by those assets that over time will grow their revenues, will generate dividends, and if it's real estate, will generate rents. So that leads to the next test question. Test question number 2, does it generate cash flow? Is it generating revenues? Are those revenues growing? Is it generating a healthy cash flow? Is it paying dividends? And in the case of real estate, is it paying rent? So all of those qualities indicate that it's a productive asset. If we look at gold, what is it doing? It's sitting there looking pretty, but it's not producing revenue. It will increase in value as long as people value that asset and want to pay more for it in the future. So that makes it vulnerable, in my opinion. It makes it vulnerable as opposed to a productive asset. And that, for me, is not a safe place to be. And by the way, I'm not providing financial advice. I'm not a professional financial advisor. I'm just simply providing you with my opinion on that. And that gets back to the important question that we said at the beginning of the video, is that before we buy anything, we really need to understand what is it that we're buying. And we're going into that with eyes open. And are we buying an asset that is considered speculative, or are we buying an asset that is considered productive? So I always favor owning productive assets. Test question 3, can it survive without hype? So that means for long periods of time that are boring periods of time where you don't hear anything about the asset, how will it do? Well, a productive asset is going to continue to earn money on its products and services, is going to grow its revenue, is going to generate dividends, hopefully, and profit that is going to go back to increase revenues. So all of these activities point to a productive asset. In the case of Bitcoin, or the case of cryptocurrencies, what drives that price? Typically is the opinion that price is going to be higher in the future, that someone is going to pay a greater price for that asset in the future. That, to me, is vulnerability, and I don't prefer that. I prefer some level of safety and assurance that the asset going into the future is going to generate revenue. So, when you apply that test to cryptocurrency as a class, it's important to remember that the mistake people are making is not buying the cryptocurrency, but not fully understanding what they're buying, that they're treating it as a speculative purchase rather than a purchase of a productive asset. And it's important to know that because the risk profile is completely different on that. If you apply those 3 tests before you make a purchasing decision of an asset, I think that you're going to be miles ahead of average investors. So it's important to know, what are you buying? Are you buying an asset that's speculative, or are you buying one that's a productive asset that is safe? I think that's what Paul Krugman is really getting at. It's about understanding why you own something and how it's expected to reward you. It has to be based in reality, by the way. So what is the reasonable expectation when you look at a speculative asset? That is a much harder thing to value than a productive asset. So the bottom line is, know what you're buying, follow those 3 tests, and you're going to avoid a lot of problems in the future. So that's our message today. Now, my question to you is, what are your thoughts? What do you think about these 3 test questions, and where do you land on what's your investing philosophy? If you don't have one, that's also good to know. So it's important to understand where you want to invest, and to do so wisely with your eyes wide open about that. So if this is a type of topic that you're interested in, feel free to subscribe. Would love to have you. Also, if you like the video, give it a like, and I hope to see you on future videos. Thanks for watching.